My name is Mat Hague. I'm from a program called CASA, which is funded by FCDO. We've done a series of studies over the last 12 months looking at climate adaptation and the extent to which agribusiness and agri-SMEs are moving towards taking adaptation and the climate change into their business processes. I think one of the messages that is clear from this whole conference is that Africa's made very little contribution to climate change, but will be both the first to suffer the consequences of it and the least prepared to be able to deal with it. Climate change isn't something that's coming, it's something that's here now. And everybody who's involved in agriculture will need to take measures to adapt to climate change in the future. What we're trying to do is to bring those messages home early to SMEs and other players in the sector so that we can minimize the damage that is done to agri-food systems from the climate change. But in the conversation around climate finance, 90% of the finance that's available is going to climate mitigation, not to adaptation. And most of that money is going to sectors other than agriculture. It's going to energy and transport in developed nations where the business models for climate investment are clear. They're backed by carbon credits and carbon markets. And African agriculture is very different to this. It's heterogeneous. The business models are largely unknown. The solutions remain nascent, unclear, and unproven. And even the funding that is available, very little of it is going into agriculture and SMEs that are key pathways into supporting smallholder farmers. So what are the things that we can do about this? I mean, I think there are three main aspects that we can consider at this stage. One is new investment models and new taxonomies so that we can have a clear approach to measuring climate mitigation, climate adaptation, and nature-based solutions. We need large donor investments to create a viable pipeline at scale, to start investing and scaling the technologies that do exist and getting them into the market and getting those companies into the portfolios of investors. And I think we need climate finance to be integrated into all aspects of agri-SME finance. Financing institutions don't have the depth of capacity around climate to be able to provide the kind of products that we need. And we've got to break down these bridges and build bridges and break down the silos between finance professionals and climate professionals. One of the things we looked at was all those different initiatives that have been emerging in the last couple of years around trying to raise climate finance for adaptation. We found more than 50 of these organizations with a total of 1,700 members across the world. The majority of these, however, are global. Very few have got a regional focus, and of the 109 organizations that are involved in more than 3, just 10 are based in lower and middle income countries. Most of these initiatives rely on their members to drive the content of what they do and the governance of what they do, and that makes it very difficult to bring private sector organizations in who may not see business opportunities in the near term from being part of these big initiatives. So what do we need to do to get more engagement of the private sector in these fundraising initiatives? I think one of them is certainly to bring in these organizations, bring in the private sector, bring in large agribusiness. We also need to bring in a localized, more nuanced approach to these initiatives. We need to get the voices of the people from the region. We need to bring in large agribusiness from the region to start driving the policy agenda. We need to coordinate efforts on metrics so we get this common understanding about what we're talking about. And we need to track the impact of some of these initiatives. Of all of those initiatives that we looked at, of all those 50 initiatives that we look at, only one of them systematically tracks impact and only one actually measures the amount of additional finance that is mobilized. We also spoke with agribusinesses and investors about how they're considering climate change and how they're considering to take on issues of adaptation. And there's some very important knowledge gaps. Climate mitigation is perceived by investors and multinationals as more easy to understand. It's more easy to invest. It's more easy to follow clear investment models for these organizations rather than adaptation. And even impact investors and other investment support partners are not very clear about the kind of impact that they're having when they invest in adaptation. And for commercial investors particularly, there's very little understanding of what adaptation is and how what they're investing in is going to generate the change in the field that they're expecting. Even if we do manage to get more financing into adaptation, there's very little in the way of investable opportunities. There's not much to spend, not many opportunities for people to invest in for these businesses. The technologies tend to be nascent, the markets are small, and so the ticket sizes for funding is also small. One of the big problems here is that these businesses don't have a very strong business case in the sense that they have to provide both immediate financial performance because the benefits from adaptation are rarely seen in the short term and often don't accrue actually to the investor. We see commercial capital, very little commercial capital flowing into smallholder agriculture anyway, and so even less is going into this, this part of adaptation. And I think most importantly, for commercial companies, one of the things that they can do about adaptation is simply move to different markets. So if you're an agro-processor and you're finding that your supply chain is becoming compromised by climate change, you can simply move to a different area. So finally, where are we in terms of adaptation technologies? There are a number of increasingly well-established adaptation technologies, solar water pumps, climate insurance, work around improved varieties of drought-tolerant seeds, where I think both the economic and the social benefits are becoming clearer. But we looked at a bunch of more innovative, more early-stage technologies around climate information, climate-smart infrastructure, irrigation, drip irrigation, solar-powered refrigeration, and things like precision agriculture and solar-powered drying and cooling equipment. And there's a number of challenges here. First of all, you're selling into traditional farming systems with very ingrained approaches to how they do agriculture. Secondly, most of the customers are on low incomes with low purchasing power. And thirdly, both farmers and investors, again, struggle to understand the climate outcomes that they're trying to determine and cannot give confidence that the investments that they're making in the technologies are actually going to generate the benefits that they desire. Many of the benefits, many of the climate benefits that can be generated from investing in these technologies around reducing greenhouse gas emissions, reducing food waste, strengthening the resilience of food chains, diversifying portfolio footprints, and enhancing brand reputation are all very important, very interesting things for investors, but very difficult to quantify. So very difficult to make an investment case around these metrics. So what needs to happen to get more money into these technologies? And I think first and foremost is about looking at an investment thesis from the perspective of the potential losses from doing nothing, like Aggie said at the beginning. At the moment, we're looking at adaptation technologies as how can they increase yields or increase profits. And we need to have a better understanding and better quality modeling about understanding what would happen if we do nothing in particular markets. We need to improve, I think, the understanding of investors on the availability of technologies, how they are expected to impact on adaptation objectives. And there are other economic and social benefits that they will be able to generate. We need reliable data systems. There's a big information gap for investors and a high cost of generating the kind of data on the performance of adaptation technologies and benchmarks on low likelihood but high impact events that would help to lower the costs for investors. And I think finally, the key route for getting adaptation technologies into smallholder farmers is through these enterprises that have existing and trusting relationships with smallholder farmers, such as through off-takers. This can be either directly selling products to farmers or making them available as part of production agreements, or facilitating third parties to engage and get access to smallholder farmers through references, through guarantees, and even through advancing matching funding. So thank you very much for your attention, and I'll hand back to Aggie and the rest of the panel.